Kenya Commercial Bank was out with numbers this morning as well over in Kenya, posting a 5% rise in 2009 pre-tax profit and adding that it would raise 15 billion shillings, that's $194 million in debt and equity to fund further expansion in the region. Already the long-term funding plans have been approved by the bank's board, subject to regulatory and shareholder approval, and the aim is to raise the money during the course of this year. To run us through the numbers and prospects for the company moving forward, KCB Group CEO Martin Oduor-Otieno joins us now live from our studios in Nairobi. Thanks so much, Martin, for joining us this afternoon. Well, KCB reporting a growth of 5% in profitability, and what's being emphasized is that when we look at these banking results, we're looking at the fact that it is growth in a very difficult time frame. Overall, are you happy with the performance of the group?
Yes, thank you. We are indeed very, very happy with the performance of KCB for the year ending 31st December 2009. It was a difficult environment, as you know, globally, and the financial services industry did not have generally a great story. I think everybody was thinking that the financial services industry had let people down. I mean, in a sense, the environment in Kenya coming from 2008, which was a difficult year, trying to recoup some of the gains in 2009. And so for us, we see that the 5% growth of our profits to 6.3 billion Kenya shillings, which is just about $85 million, is excellent performance in the environment.
When you unpack these numbers, Martin, I mean, it's growth in interest income that really stands out. We've seen that come in at 23%. That means that you're attracting depositors your way. But the Central Bank of Kenya is putting pressure on Kenyan banks to lower their rates in tandem with that of the central banks. How reliant can you be on this kind of growth moving forward, especially when your fees, commissions and revenues from Forex have been pretty flat?
It's important to note that in the circumstances for last year, a number of banks actually stopped lending because of the environment that we're operating in. But KCB continued to lend. I mean, if you look at our numbers on the balance sheet, our loans actually grew by close to 30%. I think it was 29%. And our deposits grew by a similar margin. And so the strong growth that we've seen in interest income is being driven by those numbers on the balance sheet. And for us, that is really important because we continue to support the economic activities and our customers in difficult circumstances. Now, going forward, we still see opportunities for growth in our business. You mentioned that the fees and commissions have been flat. That is true, and that's a reflection of the fact that we did not significantly increase our charges and commissions during the course of that year. We are looking at more and more ways of both growing our revenue base as well as having a sustainable business, because during the hard times, that's when your customers need support, and that's what we are giving. So for us, we still see opportunities for growth. We are focusing very much in the SME sector, which is a growth sector in this country. We also see opportunities in the area of telecommunications, construction sector, and trade and manufacturing are some of the areas which we see as having potential going forward.
What certainly is impressive, Martin, is that you've seen debt recoveries increase. We've also seen a fall in provisions of bad loans, down 57%. It seems like you've got a handle on non-performing loans. What quality of loan book are we looking at the moment, and what kind of risk mitigating strategies have you been employing?
We obviously have a fairly strong risk management and credit management process, and that has helped us both to drive the quality of the book to ensure that we are only putting on assets which are good assets through a rigorous review process, and also that on the recovery side we've got a strong team that is really working hard to ensure that where debts have gone bad, that we are moving very quickly to recover And the previous year was a bad year with some particularly strong names going bad. But all in all, we're very happy that we've been able to bring this back under control, and we see that this trend will continue going forward.
That under control. Let's talk about bringing operating expenses back under control. I mean, we've got a huge offset here being seen by those operating expenses that you've experienced. So, just how much of a concern is that for you?
You see, it's a real big concern, because you see, although our income went up in total by 17%, our costs went up by 30%, which is not a good thing. But I'd like to say that this for us is the cost of investment, because for us to continue to reap benefits on a sustainable basis going forward, we've got to invest today. And we've spent a lot of money on our IT infrastructure, which was long overdue. And we've also expanded our branch network right across East Africa quite significantly. We do see that some of those are one-time costs. And our investment in technology should begin to pay dividends through more innovative products and services and processes in the way that we carry out our business. So we are looking to seeing more productivity, more efficiency, growth in our market share, and more innovation in our bank going forward to drive down the cost-income ratio and the cost growth, while also growing incomes. Well,
Martin, while you're getting a handle on that, you're also pursuing this expansion plan on the continent. I mean, you've got operations already spanning from Tanzania to South Sudan. Have you started bearing any fruit from that labor yet? Because one would assume that would act as some motivation for you to raise this 15 billion shillings that you've announced this morning.
Yes, that is true. As you know, investments don't pay immediately. So we are in the early days of these investments. If you recall, we've been in Sudan for 3 years now. We've been in Uganda for 1 year. We've been in Rwanda for 2 years. We've been in Rwanda just for 1 year. We have a branch network of 203 branches, 165 of which are in Kenya. And with the infrastructure cost of putting this up, that is still eating into our performance. But we have begun to realize some profits from some of those operations, and we see that this will continue into the future. And just talking about the long-term funding that we're going to raise, that we intend to raise, again, we've been strapped for capital for growth and for long-term funds. We run a mortgage business which requires long-term funding. Our investment in these markets where we operate in continue to require money so that we can put on more assets. We need capital, etc. We need to generate liquidity. And so the money that we'll be looking for during the course of this year, subject to all the regulatory approvals, is money that will be used to help us support and grow our business both in Kenya and in the region. And looking further afield to our Pan-African agenda, this will come in handy.
Especially when the Pan-African agenda is on the high priority list of so many of the Kenyan banks right now.